Hello and welcome to Bloomberg Quint Live. You're watching Trendspotting. I am Shraddha Babla.
And I'm Neeraj Shah. In the next 30 minutes, we'll deep dive into specific trends in the markets to draw out key takeaways and its implications for investors. First, though, the headlines. The Indian markets recover from early morning jitters as drug makers head higher. Sun Pharma is the top Nifty gainer today after the US FDA clears a specialty drug it can sell in the markets of US. Dalmia Bharat's petition is just one of the 13 that may be brought up in front of the Kolkata NCLT in the Binani cement case. And the Supreme Court asks Reliance Communications to maintain status quo on all assets until the next hearing on April 5th. And in global news, Facebook founder Mark Zuckerberg breaks his silence on the Cambridge Analytica data breach, says the social networking site will restrict apps from accessing data.
All right, let's first take a quick look at how the markets are faring at this hour. Indian markets have pared most of their morning gains in line with the drop in Asian equities. In fact, just a marginal uptick of 7 points on the Nifty and 33 points on the Sensex. ONGC, that's the top gainer on Nifty, while OMCs continue to tread lower. Mid-cap, small-cap indices both are now in the red. The Nifty Bank largely unchanged, and the Nifty Metal Index, if you bring that up, that has fallen for the 7th straight day. As far as the broader markets are also concerned, the advanced decline ratio is at about 3:5. HCC is one stock that I want to pull up that has stumbled about 20% this week on reports that its units Lavasa may actually turn bankrupt. So largely unchanged is where the markets are right now. But let's tell you what we have lined up for you on Trendspotting today. What is making IIFL outperform other brokerage peers? We will ask the Chief Financial Officer, Prabodh Agarwal. And then we'll discuss the impact of the settlement of $31.7 million arbitration on Jindal Drilling as we connect with the Chairman, DP Jindal. And finally, we will shift focus to Newgen Software's new launches and orders as we connect with the Senior VP for Sales, Virender Jeet. All right, let's first put the spotlight on brokerage stocks. And the one stock that has outperformed peers so far in 2018 is IIFL Holdings. In fact, that is the only counter which has actually given a positive return so far this year. What have been the key factors aiding this improvement or up move? Let's ask the management. And joining us in the studio is Chief Financial Officer Prabodh Agarwal. Good morning, Prabodh. Thank you very much for joining us. You know, if we could start off by you giving us a broad outlook as far as your capital markets businesses are concerned, because 2018 may not really be as good a year as 2017 was. So, and that could really have implications for all your capital market businesses.
Yeah, so if you look at our capital market business, it consists of three main parts. We have institutional broking, retail broking, and investment banking. Actually, the going has been good for all the three businesses. While you're right, that the market, that the businesses can be cyclical, can be volatile. But our experience that over the last 10 years, the businesses have all been profitable. The profits have varied, but we have not had a loss kind of situation. That's point number one. Point number two is that we believe that the market volatility will not be as bad as it used to be in the past, primarily because of the large participation of the domestic institutions. The fact that SIP and the domestic institutions have become such a large player. So despite the global factors and all that, and despite the large inflows or outflows from the FIs, the domestic markets will be relatively stable, which is good for the the broking business. And what we find is that so far, even YTD, all the three businesses have been doing well. The investment banking particularly has been doing extremely well. The pipeline for new deals have been pretty good in terms of IPOs, QIPs. So we'll see how it goes going forward.
Prabodh, you've announced a three-way split of your businesses. What are the timelines for the listings, and what is the kind of value unlocking potential that you see in it?
So we have announced a demerger of the three key businesses: IIFL Finance, IIFL Wealth, and IIFL Securities. We believe each of the business has now achieved a certain scale in size in terms of the total AUM or profits, and therefore now in a position to stand on its own. We believe that by separating them, we will allow them to grow to their full potential. Therefore, the demerger scheme was announced in late January. Last week, we have filed the scheme with the stock exchange and the SEBI. That's the first step. Next, we'll have to approach the NCLT, and we'll also have to approach all the regulators, that is SEBI, RBI, NHB, etc. And then, we have to approach the company law board. There will be shareholder approval, there will be creditors approval, etc. So it's a process which will take about 10 months. After that, the final scheme will be filed with the ROC, and then we'll be ready for listing of the 3 key businesses. So I would think that the listing is about 10 to 12 months away.
Even from here.
Prabodh, good morning. Now, it takes something in terms of sentiment or business or both for stock prices to do what they've done in a scenario like this, wherein almost every other NBFC, I wouldn't just call you a pure brokerage right now, an NBFC, almost all NBFCs have been under the water. The sentiment has definitely spoiled due to rising bond yields or otherwise, and the constant questioning over the cost of funds as well. How will that overall business mood shape up for calendar year 18 or FY19 as the case may be? Part 2 of my question would also be, I was going through what Prem Vatsa has mentioned in the Fairfax annual letter as well, and consistently he keeps on talking about the kind of high growth rates that the IIFL consolidated business would have for the next few years and not just for FY19. If you can give us some perspective here.
Yeah. So firstly, on the first part of your question, which is the operating environment for the NBFCs, surely the operating environment is getting difficult compared to what we have seen over the last 2-3 years, primarily because the cost of funding is rising. We had a pretty easy period for the last 3-4 years where enough funds were available for us to borrow from the banking system or from the market at very competitive cost. So we have been seeing a very sharp drop in our cost of funds over the last 2-3 years. And as of last quarter, our average cost of borrowing is about 8.4%. And our incremental cost of borrowing is close to 8%, which is very good for a AA rated company like us. Now in this quarter, what is happening is that the incremental cost of borrowing is going up from 8%. We'll probably see it going up to between 20 and 30 basis points, and which is still manageable, I would say. But then the availability of fund is also a question mark, because a lot of PSU banks are now actually pulling back. Because as you know, almost a dozen PSU banks have been put under the PCA, and because of that they are reluctant, or they are very, very selective about lending. Even sanctioned lines of credit are not, we are not allowed to draw down from the sanctioned lines of credit. So we'll have to be more careful. We have to plan our borrowing accordingly. We have to keep some buffer, more liquidity with us, which will mean that our cost of borrowing will go up. Overall, we'll have to pass on much of this cost of borrowing to our customers. So you see, all our product lending rates going up, home loan rates, LAP, commercial vehicle, gold, capital market lending, SME lending, all these, you will see. We have not raised rates so far, but you will see that. But overall, we think, that we'll be able to manage. The overall credit demand is still very strong, because the other factor is that because PSU banks have gone slow for a while.
Yeah, they've not encroached upon.
So they're not encroached upon, and actually this is going to continue. In our view, this will continue for a pretty long time in future, and therefore the credit market is open for the private banks and the NBFCs like us. So that's good, and we have enough credit opportunities. So I would still say that it's a decent environment for NBFCs and banks to grow, despite the cost of borrowing factor.
So grow with the similar operational metrics and similar NIMs, or would you be able to pass on these costs, and will there be enough demand there, or would there be a part and part? Some part will be passed on and some part will see a squeeze in NIMs.
So our endeavor would be that currently our NIMs are around 6.7%. Our NIMs should be between 6.5% to 7% going forward as well. Okay. So you may see a slight squeeze in 1 or 2 quarters, but then overall, if you take a 12-month period, then we would be maintaining our NIMs at that level. You would not see a squeeze. And we think that is doable, because there is enough demand, even if we were to raise rates by, because the entire market will move up. In terms of asset quality, in terms of OPEX and all, I think all those operating parameters, we should be fine. So, I would think that, our endeavor would be to show a similar kind of trend in terms of reduction in cost-to-income ratio, reduction in credit cost, and ROA, ROE going up.
Okay. I still have a question on the demerger. I believe that there is no lock-in period for promoters and employees, so no lock-in restrictions. Just wanted to understand, I'm assuming the promoters are not looking to dilute their stake in any of these three entities. And what does that really mean with respect to minority investors like CDC, General Atlantic, Fairfax, any of them? Have you had discussions with them? Anybody's looking to exit because this is a good price discovery mechanism.
So the promoters are not looking to exit.
Okay.
The promoters actually have not sold a single share for the ever since listing. So their stake has remained the same, and that is expected to be the case going forward as well. The strategic partners, General Atlantic and CDC, again, when they came in, they have come in the last 1.5 to 2 years. And they came in with an initial investment period of 7 years. So it's just that the listing is happening much earlier than what they would have also expected. But that doesn't mean that they would be looking to exit anytime future. Because actually our performance in the last 2 years, ever since they came, has been so good. Actually, they have made their investment has appreciated much more than what probably they would have appreciated, what they would have expected. But we don't get a sense that they are looking to exit anytime soon. Because the other thing which you mentioned, the Prem Vatsa's comment that there is a long runway ahead. The financial services business overall, and particularly the three businesses that we are in, which is NBFC, wealth and capital market. We believe this is a early stage of the growth. Indian economy, the kind of broad numbers we are talking about, and then the overall penetration of the financial products and services. So I would think that there is a long way ahead. So none of these partners are in a rush to exit.
If I can squeeze in a question on that, actually, Prabodh. So it's common knowledge that a company, a conglomerate, whatever you call it, would go in for this demerger exercise because they believe there will be better value creation immediately and over a period of time as well due to this exercise. So I'm guessing the base point is that finer details about whether you believe that any of the three listed businesses or any of the three separate businesses deserves a better multiple from the markets but is not getting that as a result of being clubbed with the others. Is there some thought that you guys have given to that as well? So
there is going to be an immediate value unlocking, and as you have seen, when we announced the demerger, there was an immediate reaction on the stock price. But that's more of a short-term reaction. But we believe that definitely there is a lot of value unlocking going ahead, because each of the businesses, will be able to grow. There are a lot of positives which people do not fully appreciate. There are disadvantages of having a conglomerate structure. So people are focused on the fact that synergies are there between various financial services companies, and therefore the question is that will the synergy be lost? So the answer we have been saying is that the synergies are definitely not going to be lost, because even now, whatever synergy is tapped between the group companies, that is all priced at an arm's length. There is a fair pricing, and it's all approved by the audit committee and the boards of each of the companies. That structure has been in place. So, for example, if the wealth uses the institutional research, the institutional research gets paid for that. If the investment banking sources a deal for our alternative investment funds, again, they are paid for that. If a broking, unit sources a home loan for our customers, then they are paid. So that will continue. So this is the group synergy that we are tapping. And therefore, what I believe is that given the fact that each of the business is catering to a different customer segment, a different, has a different growth potential, has a different risk, is regulated by a different regulator, we believe that, it makes sense, which people will gradually realize and will appreciate. And that will create, value unlocking. Specifically, the perception, that we were earlier a broking unit, we started with that. Now, and broking, again, people associate that with volatility and...
but that's such a small part of it.
But that's now, you must realize that's become a smaller part.
8%? 10%?
So today, if you look at first 9 months profit, then about 50% of the profits came from NBFC, about 30% came from the wealth, and about 20% came from the capital market. So what has happened is that over the last 5 years, if you see, the share of wealth and NBFC has been growing, not because capital market is less profitable, but because the other two businesses have grown much faster. I would think that will, that will be the trend going forward.
Just the last question from my side. Do you not have any asset reconstruction aspirations, unlike some of your peers like Edelweiss or JM Financial, who are big players in that space?
Yeah, so asset reconstruction is on our radar, but right now, we are at a very early stage. We're just putting in an application with the RBI. But if you look at our group structure, we are most focused on the retail. Retail products, whether it is retail broking, insurance distribution, or NBFC. ARC is more of a wholesale business. But having said that, of course, it is financial services, so we are open to it, but we'll do it.
Okay, great. Prabodh, thanks so much for taking the time out and joining us and giving us that perspective. On to the next management, Shraddha.
Thank you.
Thank you very much. Moving on, let's shift focus to Jindal Drilling. The stock is trading with gains of over 10%, and this comes in after the company settled an arbitration award of nearly $32 million for $9 million. What has been the rationale behind this, and how will this impact the company's books? Let's ask the management. Joining us on the phone line is the chairman, DP Jindal. Good morning, Mr. Jindal, and thank you very much for joining us. Had you already provided for this $32 million because of the arbitration award that was passed against the company way back in December 2016?
Yeah, good morning. Actually, we have provided in contingent liability, but this year, whatever is the settlement, 9.1 million, that will go in the current balance sheet.
Right. So you said that this $9.1 million payment has been made. Just wanted to understand, when was this made and how was this funded? Because your cash balance as of 30th September is just about 8 crores or so.
Well, actually, we have paid 5.1 million and balance is the tax which will be depositing. Total is 9.1 million. And this fund came from the reserves of the company, and company has its sister companies, so we took it from there.
Sir, also a quick word on how the fourth quarter so far has been. Have you seen any sort of a traction or uptick in the order book?
We are in the rig business, so our at present one rig is working, and we got a contract for the second rig, and we are in process of getting 21 MLU, that is mud logging unit order from ONGC, and fourth quarter, of course, when this 9 million will be the effect, so fourth quarter will be affected.
Right. So broadly, so that's the picture. We get the picture for FY18, but so from an FY19 perspective, what kind of growth in the revenues as well as margins do you anticipate?
Yeah, we would like to have better growth in FY19 because these settlement and other things are over. The oil price is going up, and even the day rate in the rigs are also firming up. So we see FY19 will be better.
And sir, the short-term debt had been reduced from 77 crores to 20 crores. Where would this number be standing at currently?
I don't remember, but I think it's not increased. Short-term debt is not increasing.
All right, so thank you very much for joining us here on Bloomberg Quint. Appreciate your time. So Jindal Drilling, that stock is trading about 9% higher or so, and that's given that the final settlement, the arbitration award was against the company back in December 2016. So instead of, based on the settlement, instead of the $31.7 million, the company will have to pay $9 million. Now that was a contingent liability on the books of that company so far. But that $9 million could have some impact on the FY18 numbers. with that, let's just also take a quick look at where the markets are at this point in time. The Nifty and the Sensex have turned negative, not too much movement. They were trading flattish when we started off this show, down about 4 odd points on the Nifty index at about 10,150. So that's as far as the markets are concerned. We move on from arbitration settlements to new launches. And for that, we have the management of Newgen Software, where the company seems to be on a roll. They have released a new mobile Medicare enrollment solution for US healthcare plans, and has also bagged a 53 crore order for digitization in the districts of Madhya Pradesh. To shed more light on this, joining us on the phone line is the Senior Vice President for Marketing and Sales, Virender Jeet. Good morning, Virender, and thank you for joining us. If you could just tell us how your product or solution offering for US health plans differentiates from some of the other health plans.
Yes, so good morning and thank you for having me. Shraddha, what we are focusing is one of our focus area in US is beyond banking is on health plans. And in health plans, there's a huge opportunity around what you call mobile Medicare enrollment, where you could really optimize the cost for enrollment by providing digital solutions, both on mobility as well as completely making them paperless. I think we are globally known for our products in the spaces of mobility, imaging, and that's those trunks we have carried to this segment and recently launched up. We've already got early successes in this segment. And with our products, we are very well poised to, there's almost a market of around 200 health plans in US. And we think over the next 3-4 years, we can build a strong presence in that space.
If you could give us a little more details on with respect to what is the kind of market opportunity for this kind of a solution offering, and what is the kind of revenue that you expect to generate from this sort of an offering over the next 2 years, probably, like you said.
Yeah, so as I told you, the overall, if you look at the market opportunity in health plans, there are multiple products which we sell. This is just one of the product lines which we recently launched, and as I told you, the near addressable space is roughly around 200 health plans. Our typical deal values in these health plans range somewhere anywhere between $400K to $1 million to enter, and then they can grow later. So for us, it's an incremental market for us. It's not a substantial shift. While as overall today, the health contributes roughly around 12 to 13% of our revenue. So it will increase that percentage of that segment. But in US, it's not just health segments we look at. We are looking at many more segments. We have government as a strong segment. We have banking as a strong segment. And we have interesting product pipelines in those segments as well planned.
Right. So based on your product pipeline, how much do you think US market contribution to your overall sales mix can go up to by 2020?
So we are roughly around 26-27% today. And as we start moving more and more towards penetrating the mature markets, we think in next 4 to 5 years, there's a possibility of at least moving to around 30 to 40% of revenue coming just from US.
Okay, and Newgen just recently has been recognized as a leader in dynamic case management, digital process automation and ECM by Forrester. What will this recognition do for your business in terms of opportunities, and has it helped the company in getting any leads for orders? I know it's too early, it's just been 3 or 4 days, but what kind of opportunity can this throw up?
I think if you the enterprise product space, recognition from these independent analysts like Gartner's Forrester is very, very essential, because they become some of them the most kind of an eligibility criteria or a qualifying criteria to be considered for. So having the global recognition, being one of the top 3 companies to be as leaders in these, surely has got its own merits. But as you rightly said, that these are what you call recognitions. They become inputs to enterprises to make their decisions, do become also globally lead sources for us, so that our inbound leads start generating better as we start improving our position in these quadrants or what you call wave reports. So you're right, they do help our business, but you can't have direct association with that leadership position with dollar values or in terms of number of leads. But while we do expect acceleration in our opportunity generation because of these recognitions.
All right, and just the last question, Virender, before we can let you go. How has the fourth quarter been so far? What is the kind of revenues you think you'll be able to book in this quarter? And will that be accompanied by higher margins as well?
I think we are so far as per the year, we have been on plan. We have a track record of growing roughly around 20%. And we hope that in this we should be able to be on that track for this year. And in terms of margin expansion, yes, I think we are looking forward that at least by a few points the margin expansion should happen every year going for at least for the next 2-3 years. As our cost bases are pretty much not related to the top line. So top line is pretty much independent of many cost bases. And as we increase our sales of licenses and higher gross margin revenues, we should be able to expand the margins. So far the year is looking good, and let's wait for the results, and I think we should be doing fine.
All right, Virender, thank you very much for speaking with us and wish you all the very best for the years going ahead. And with that, it's a wrap on this edition of Trend Spotting. Up next is Hot Money with Darshan Mehta. Stay tuned in.